So as we move on to look at the kind of the development outlook, if you touch this in any way with a lending on it, or you're the developer or investor in these things, it's really important to recognize that population growth, which is the least exciting topic you can probably think of, unless you're involved in apartments and unless you're involved in commercial real estate, in which case it's very exciting because that is what drives a lot of this. So something to take away from this is Missoula County's growth over the last 9 years. And you can see that from 2010 to about 2013 or so, that the growth is pretty flat, below 1%. And that has a lot to do with the job picture in town. And then from 2013 to 2016, it starts to pick up a little bit. And then from 2016 on, it's picked up pretty considerably to where we're now at 2% growth annually in population or greater. And so, again, who cares about this stuff and why does this matter? If you're investing in these asset classes, how do you predict what the future demand is for apartments if you're investing in apartments? So there's a pretty simple formula that ties back to population growth. So if you can anticipate what the population is going to be, you divide that by what the average household size is. You take the product of that and then multiply it times the percentage of the population that are renters, then you should know how many rental units are going to be demanded in the future. So if you're again, if you're a developer, if you're a lender, you are really interested in this information. And because my mom's a math teacher, I have to put the brackets in there to do it right. So, again, where does this go? So I know that doing complex math problems in public is generally not recommended, but here we go anyway. This will give you an idea of how many units would Missoula County support if the growth rate stayed the same. So it's 2% growth rate last year. If 2% was this year, what would that look like? So population's about 122,370. You have 2% population growth rate. That means that you'll have 2,447 people that would come to Missoula net in 2020. You divide that by the average household size of 2.29, which will tell you that we need, across the board, of all types, 1,069 housing units. So that's single family for sale, multifamily, single family for rent, the whole, across the board. You take that number times the percentage of the population that is renters, which last year, 43% is what the American Community Survey tagged the percent of Missoula County that are renters, which will tell you that we need 460 rental units to keep up with demand. So of all types. And then of that, about 60% of the rental units are people that are in apartments, multifamily apartments. So there you go, 460 units total, 275 of those would be in apartments. So that's at 2%. That's if we continue to grow as we did. But as we talked about earlier, there's a lot of uncertainty. It's hard to predict exactly what will happen. So if we run another scenario and just say that everything else is the same, except our population growth is only 1.5%, you can see that we would demand about 115 less total rental units and about 70 less apartment units. So again, this is very interesting if you're looking at building these, building new properties. How does this all fit in? So this slide here is trying to show demand and supply and then where are there gaps. So if you look at this is from 2010 until 2019. It's all the residential permits issued each year. And this is information reported by the county to the Census Bureau, which is where we pull this information from. And if you look at it, the blue is single-family delivery, single-family permits. So not deliveries, it's permits. And then yellow and orange are multifamily. So the other important thing to note here is that if it's permitted in 1 year, for apartments at least, it's probably going to deliver the next year. So its impact on the market will be the following year. So important to note that distinction. So think of these bars as our supply, and then this is the housing unit demand based on population growth and average household size. So by putting these two over top of each other, you can start to spot where there's gaps in supply and demand, which is also where there's usually opportunities. So from 2010 till 2015, you can see that we were generally slightly underproducing the amount of housing units that we need for this market, which caused vacancy rates in apartments and that sort of thing to kind of compress over time. And then the market catches the signal in the 2016 and 2017 timeframe, and you can see that we built a ton of apartments, 1,100 thereabouts, in that 2-year timeframe, so 2016 and 2017. And then those units start hitting the market in real force in 2018, which is why vacancy at that time spiked for apartments. But then the very next year, in 2018, you see that the overall permitting, both the multifamily and, so single families were up slightly, but multifamily was way down, and that trend continued into 2019, and we delivered far fewer than what we needed. So you can see where we have these housing shortfalls, which then does two things. It decreases vacancy in apartments, multifamily apartments, and then it increases prices of single-family rental units, single-family houses too, and the price of them goes up. Both of those everybody's seen. The median home price is up above $300,000, and then the vacancy rates are now coming down on apartments. So, but here is one important takeaway from this is that there's interchangeability between single-family housing that's built for sale and single-family housing that ends up being rentals, and then multifamilies. The overall supply of housing created relative to the demand for those units due to population growth should be viewed more holistically. In the past, we've really tried to segment it out like we did in that previous slide where we say, okay, there's going to be 460 rental units and 275 of those are going to be multifamily. But what we're seeing in practice is that when we're under-delivering as a whole, people who otherwise might have wanted to purchase a house can't do it. And so now they are moving into apartments or staying in apartments, not necessarily by choice, and it's causing the vacancy rates to go down. So crucially important information if you are in the development world especially, but if you're looking at existing properties, you have to keep this in the back of your mind. So as we look at the tracker, basically what development projects are in the works for the future, this also helps to predict vacancy in the future and demand in the future. So in 2019, there was 266 units that we were tracking that were delivered, which is pretty close to what, if you do that formula that I showed before, about what demand is, maybe a little bit under. But if you look now, in 2020, there's only 170 units, or 169 units that are under construction. So given the demand curve that we showed, it looks like there's going to be another pretty big gap in deliveries of units versus what is actually demanded in units. So that would indicate that your vacancy is likely to stay tight or even get tighter, if that's possible, in the apartment market this year. One other thing that we should recognize from this is that the more difficult that the city and the county make the creation of new lots by increasing subdivision regulation or by gutting the townhome exemption or by creating uncertainty as to what it's going to cost in infrastructure if you develop new lots. So the more that the city and county does that, the more apartments and rental communities will be constructed as a percentage of overall deliveries. And the reason for that is because you can generally do an apartment project without having to go through the 2-year struggle of trying to subdivide land. So a lot of developers are saying, well, I'll build apartments because why would I want to fight the city for 2 years and maybe not end up doing the project? So what we anticipate from this trend, so both the demand trend that we talked about in the previous slide and then also what is currently in the pipeline, is that the vacancy rate will stay about what it is or go down in 2020. And then in 2021 and 2 and 3, it's very likely that vacancy will start to come back up for apartments. That's unless the mayor currently has a working group that's working on subdivisions, trying to streamline that process so that it's not a 2-year fight and struggle. And if that is successful and you're able to make new parcels more quickly and then therefore create more single-family homes, then in theory you would have additional supply of these single-family homes. And then you look and see on our chart here in 21, 22, and 23 and beyond, you're talking 2,100 new units of apartments. If those deliver, or if some large percentage of those deliver, you're going to see vacancy rates come back up. So if you invest, develop, finance, or provide guidance to anybody that touches the apartment world, I'd say the 2 things that you want to take away from tonight are that you should pay attention to hiring and job growth, because that is what informs what the population is going to do, because population growth follows job growth. And then you should pay attention to the total amount of housing units that are being delivered. So whether that's single family for sale, single family for rent, or multifamily for rent as well, and then make decisions accordingly.